Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner and founder of Menninger Associates Financial Planning. We are going to do a series of episodes on questions and answers, mainly because of the fact that they've been very popular based on views and just feedback that we've received from other episodes that we've done. And I'm joined here by a couple of my associates. I've got Kyle Ryan to my immediate right, who is also a certified financial planner, and I also have another one of my associates, Ryan Keefe, all the way to the other end. And so what we're going to do today is, this is the first of several episodes where what we did is we gathered commonly asked questions, either by our clients or being pulled down off the internet, what have you. So what we're going to do on this episode, as well as all of the subsequent episodes, is we're going to show the question up on the screen for just a few moments and basically do a panel discussion in answering the question. So guys, thanks for joining me. I appreciate it.
Yeah,
and I say, hey, let's ready to go. Let's fire away at the first question.
Jump right in.
What is meant by financial planning? Well, okay, that's a very broad one, and I know this one, I had a sneak preview towards what this question was going to be. We come across this all the time. What is financial planning, right?
It's a good first question. I mean, the show's called Financial Planning Explained.
Imagine that. Hey, how about that? Exactly. Well, one of the things I think we all notice is that people think that you need to have lots and lots of money in order to use a financial advisor, or need a financial advisor, or do financial planning. Mm-hmm. And I've always been a proponent. It's almost like a doctor. It really helps to be able to have financial planning, at least point you in the right direction. Mm. And particularly if you don't have money, because of the fact that this will help guide you in the right direction to put you into a better situation.
Right. I know a lot of times we've had clients come in that have been, quote, embarrassed by their financials. And it's like, hey, leave that at the door. This is where we set you on the path to get things where you're not embarrassed.
Yeah. Well, and similarly, they say, well, I feel like it's been too late. I should have done this a long time ago. Well, better now than never.
That's right. Yeah. You don't plan to fail, you fail to plan.
That is correct. So if you really look at financial planning, and this is basically all the different areas as it approaches, when you're taking the CFP exam, is the 6 areas of financial planning are cash management, tax planning, risk management, which is also insurance planning, investment planning, retirement planning, and estate planning. And if you think about it, cash management is today, and estate planning is the end. Mm-hmm. So let's talk about each one. Yeah. Cash management. Mm-hmm. Well, what's cash management? Mm-hmm. Basically taking a look and, by the book. Cash management is how much do you make, how much do you spend, and hopefully you make more than you spend. That's by the book. Yeah. Well, we approach it differently. We like to look at clients' assets and debts. Mm-hmm. And we focus more attention on debt, surprisingly enough, than assets. Yeah. Mm-hmm. And because, you can dramatically improve your financial situation by cleaning up your debt.
Mm-hmm. Oh, gosh, it's the fastest way to do it.
Absolutely. And so it's remarkable how many times we come across people who have home equity lines of credit, which, I think is one of the best financial planning tools available to you, as long as the first 2 words aren't woo. Look at all this extra money I can spend. But we just came across it yesterday, where now with the rising interest rates, home equity lines of credit, as you know, are a variable interest rate. Every time the Fed raises rates, immediately the rates on a home equity line of credit go up correspondingly. And now the prime is 7%. The interest rates on savings accounts have not gone up correspondingly. No. And back in 2021, before all of the rate hikes by the Fed, it was 3
Yeah.
or 3.25%. And, that was pretty cheap money.
Right.
But now we come across clients, and you do too, I'm sure, that they have a whole bunch of money in their savings account or checking account because it makes them feel good.
Yes.
Meanwhile, they got this giant home equity line of credit or balance under line of credit. So literally just yesterday I had one where they had actually had $70,000 in their checking and savings and $110,000 on their line of credit. I'm like,
Earning 2 to cost you 7.
earning 2, it wasn't even earning 1. It was earning less than 1.
Yeah.
So we just did a quick calculation. I'm like, all right, let's just say you are earning 1. Or 0.5%. Actually, they're earning 0.5%. 0.5% of 60 grand is $300 a year.
Yeah.
And then they have to pay taxes on it. All right, a little bit. So you have to pay tax on it. They're earning like $250.
Yeah.
Meanwhile, that same 60,000 at 7% is costing them $4,200 a year. That's crazy.
That's how. Good.
And the same can be said of people with high balances on their credit cards. Even worse.
Absolutely.
Yeah.
Absolutely. So just in the feel good, I mean, the reality of it is you got to understand and make sure that if you do have a line of credit, can you access the money? And the answer is almost always yes, except if you're one who's brought it to the top, not making payments, the bank wants their money back, but that's sort of the rare occasion. But just by them moving 60,000 from their savings account, which is earning squat, they're saving just in interest $350 a month. That is not a small number.
No.
Yeah.
So
that's what I think is really cool about what we do too. Is it's not just by the book financial planning. This is right. This is wrong. It's you have to take the emotional component into it, right? Because you tell someone, hey, you have $70,000 in your savings. Why don't you take all of that and apply it to your home equity line of credit? I have $0. People can't. People want to feel safe when they have money. So you have to really, you have to balance your clients' comfort levels here too.
It is.
And
It's
this
tough.
applies to everything, not just cash management.
Oh, absolutely. And that's one thing about financial planning that you got to be able to put your head on your pillow at night.
Right.
And, particularly in this case where we're pushing money from the savings, and he was explaining that his wife is like going to be feeling really uncomfortable about this. But it's just recognizing and understanding that if you had an emergency and you needed the money, you could always just move it right back again from the line of credit.
Yep.
Right.
And so to your point also is if people had credit card debt, and how many times do we run into that? They have credit card debt. So what we've done is if they own a home, we enable them to, or suggest that they take out a home equity line of credit, use that as an emergency reserve, and then take some of that excess money that they have in savings and pay down the debt. It's a little bit of a shell game, but at the end of the day, they still have their emergency reserve.
Right.
It's just instead of it being in the form of savings, it's in the form of access to money.
Yeah.
Yeah, and it's amazing what I've seen over the years, I'm sure you guys have too, is people will be very cautious about where their checking and savings goes. Oh, it's got to get into the money market account because that makes an extra 0.025%. But they're not too cautious about adding to the credit card that's charging them 18% or more.
I know.
So it's an interesting way of seeing things.
Oh, and I like the high yield money markets.
Yes.
Woohoo! They earn 0.5%. Oh my goodness! Like not even a year ago, the high yield money markets were like 0.1. I'm like that is actually kind of funny.
It's awesome.
Yeah.
But a lot of people also don't understand how the credit card system works. And if they're carrying a balance from month to month, what ends up happening is that they pay interest daily for the entire month of whatever the balance is. And even if you mess up and are late on making a payment or don't have the money to pay it off entirely, if you pay it off even 2 or 3 days after the end of the month or the beginning of the billing period, what you're at least going to do is save all those days worth of interest during the course of the month. 18% is not a small number. That's 1.5% per month.
Yeah.
And what people don't realize is how much money is going out the door And the other thing too that we did a lot of, as you guys know, from the cash management perspective is, looking at people's balance sheets, you look at their assets, you look at their debts, and what we were able to do a lot of, again, last year before the interest rates rose, is we had them refinancing debt.
Yes.
Taking their existing mortgage, refinancing it from what might have been 5% because they took their mortgage out 15 years ago. And they could get a 5% mortgage, drop it to 3%, and actually trim down. They might have had 12 or 13 years left on their mortgage, trim it down to 3%, reduce their payment, reduce the amount of time that they're having to pay it off. Therein lies.
Reduce your minimum payment, keep it where you're at, and get that thing off your book sooner.
Absolutely, absolutely. So all of the above works, and that's why, again, it comes down to understanding the cash management. We take it to the next level of understanding how we can maximize efficiency just by looking at someone's balance sheet, their debts and their assets, and fixing it. Fixing debt can save hundreds of dollars a month that can either be used to plow back into paying down debt or plowing back into some of their own goals and objectives.
Yeah.
It's really getting them organized, and especially on the debt side, as you pointed earlier.
Well, and then it's not just organized. One of our mantras is,
knowledge is power.
Knowledge is powerful. Education and knowledge are powerful, and a lot of people just don't know. They just don't know, and there's nothing wrong with not knowing. You teach them, and all of a sudden, they're like, wow, okay, this is a whole lot better. This makes sense. It's an enlightenment. Wow, I'm saving $350 a month just in interest, just simply by moving money from this account to this account, and not losing access. It's a beautiful thing.
And that's why I like it being, the first area of financial planning that we cover, because financial planning is a long-term process. You might not see the impact of what you do today, but it will have a good impact on you later. This is something that immediately creates efficiency in your
Correct.
in your plan.
Absolutely, which then helps into the other areas, which is absolutely correct.
Absolutely.
So, and I like that you just said that. Financial planning is a process, not an event.
Yes.
And I try to instill that on a lot of people who come in and want to talk to us. Hey, can you do a financial plan for us? I'm like, well, yeah, I certainly can. In fact, we encourage it. But the financial plan is a snapshot in time.
Right.
It's a long-term process.
Yeah,
So,
absolutely.
anyway, cash management, that was a simple one. And we spent 5 minutes on cash management. How about that? All right, so the next area is tax planning. And, I need to preface that for all of the regulators out there. We do not do taxes. We don't want to do taxes, and we do not profess that we are tax experts. We leave that up to the accountants. The accountants, the CPAs. Personally, I believe that the CPA is worth his weight in gold.
Of course.
I've always known a lot about taxes, tax strategies, tax planning, but I also know that the CPA knows a whole lot more than we do about taxes. So what we try to do is, the beauty of it is that us and the CPAs look at it from different lenses, in that the CPAs, again, they know way more about tax. They've forgotten more than what we know, okay? But they have to know all this. What we know is that small wedge of the taxes that are directly applicable to financial planning.
On a personal level.
That is correct, correct. Whether it's the whole concept of, is my home equity line of credit tax deductible? That certainly has changed since the 2018 tax law. It's remarkable how many people think that their mortgages are tax deductible. Now, mind you, in theory, they're tax deductible, but if they don't exceed their standard deduction, in practice, they're not. So we're going to pick up on the tax planning piece in just a few moments, but right now we're going to break, and please stay tuned. We'll be back with you in just a few moments.
Have you saved enough for retirement? Are you financially prepared for an emergency or unexpected event? Have you thought about your financial future?
Hi, I'm Mike Menninger, founder of Menninger Associates Financial Planning. For over 20 years, we have been answering our clients' questions just like these as we develop unique and comprehensive financial plans tailored to meet their needs. When addressing your financial plan, we incorporate your entire financial picture, including taxes, estate planning, as well as investment planning and retirement planning. So call us today for a complimentary, no obligation consultation.
A unique approach to financial planning.
Welcome back to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, and I am with my guests who are associates of mine, Kyle Ryan, also a certified financial planner, and Ryan Keefe, all the way to my right. And it's remarkable. We're asked one question: what is financial planning? There's 6 areas of financial planning, and we just got started on the second one. All right, so we're talking about tax planning, and to sort of summarize what we talked about is the accountants know way more than we do, okay, about taxes. But it's our little wedge that we utilize for the purpose of tax planning in tax planning strategies and the consulting, because that's the piece that applies towards the longer term. Not to take away from accountants potentially doing longer term planning, but they're focused a little bit more on last year and this year, whereas we're looking at this year and in the future, typically as it pertains to retirement planning. What are their tax brackets today, and what will their tax brackets be when we anticipate retirement? And boy, do we do that. Like, that's such an integral part of our business practice. In fact, you take a look at the 6 areas of financial planning, and what we didn't specify in the beginning is how they're all integrated.
Yes.
And so I always tell people you don't want to get between these ears because it's like all kinds of stuff going on. But anyway, of all of them, that's most integrated is the tax component.
Yes.
Because the tax component comes into play with your cash management, as we were talking about. The tax component comes into play with the risk management, maybe not as much, but certainly the investments, certainly the retirement, and certainly the estate planning. So that actually kind of just lays it out. So the tax planning, one of the things that we do as it pertains to that is, particularly for retirement planning, is people are contributing to their 401ks. And we had an entire episode on Roth versus traditional. And it all comes down to what is their long-term expectation of the future tax laws. And right now we're talking about at the end of 2025, they're reverting the tax laws back to where they were under the Bush administration between 2001 and 2017, which is higher than what they've been since 2018. In fact, the reference we like to make is the IRS is on sale. Okay, and let's take advantage of the IRS being on sale. So,
and one thing I always like that you've always said is, it's not something you do come April when you file your taxes. It's something that you're doing all throughout the year, and a lot of the decisions you make impact your taxes. So it's something that you constantly have to be aware of.
Well, and the practicality of the matter is, come April 15th, it's too late. Most of the tax planning has to be done in the prior year. In fact, that's our Q4. Our Q4 is year-end, not just tax planning, but year-end planning. And obviously taxes take a large component of the year-end planning that we do. And just, the tax planning comes as part of everything, even the investments.
Yeah. And as you always say, it's not how much you make, it's how much you keep.
Correct.
And if you're, it's it seems so minuscule to some people just starting their new job. Hey, do you want to contribute to the 401k or the Roth 401k? How much do you want to contribute? And those little questions and answers that you submit could have a profound impact on your retirement plan
down the
later
pike.
on. Yeah.
Down the pike. And it's funny you say that, is for those people who have pensions, generally speaking, the pensions are subsequently going to drive the taxation of their Social Security, such that the IRA money that they're making contributions to, or the 401k, which turns into an IRA, if they do it pre-tax, it's creating a bigger problem on the back end.
Yep.
Right.
So that's interesting. The whole tax planning component and the strategies that we develop, again, are so integrated in every facet of what we do. And again, we don't do taxes. I don't want to do taxes. I have no interest in doing taxes. But the planning is so important to everything we do.
And that's why a lot of times when clients ask us a question, it depends is the answer.
Right.
And why is it always it depends? Because a lot of times it's dependent on the taxes.
The
it's
tax
dependent on
impact.
your tax impact.
That's correct. That's correct. So chances are we're going to talk about it, so we could spend hours just talking about the tax planning component. So what we'll do is we'll talk about the risk management. Risk management is basically the insurance planning, okay? And if you understand insurance, all insurances operate the same way. It's based upon you pay a little bit to protect yourself from a major financial disaster. Homeowners insurance, automobile insurance, life insurance, disability insurance, medical insurance, liability insurance, long-term care insurance, they all work the same way. And the idea, again, is that the more likely something is potentially happens, the more you're going to pay.
Yep.
Right.
But it is very important to be adequately insured, because I use the example, if your house burned down and you didn't have homeowners insurance, for most people that is going to be a catastrophic event.
Absolutely.
And who doesn't have homeowners insurance?
The banks
Right?
require.
Well, the banks require it if you have a mortgage.
That's true.
Okay,
Yep.
because you bet they're protecting their asset.
Oh, of course, yeah.
Okay, you don't have automobile insurance and you wrap your car around a tree, guess what? You're not getting any money for that car.
Yeah.
So, those are some of the more simple ones, but, life insurance, and this really deserves its own episode. And I think each time I keep saying I'm going to do an episode on just the life insurance, how much? Because people say, how much is enough?
Yeah.
What type of insurance? How long should I have insurance for?
Yeah.
And so that's going to be an episode of its own. And disability insurance. Disability insurance is usually offered through their employer.
Yeah. Go ahead.
And when it comes to insurance, one of the things I always tell people to keep in mind is, nobody likes to pay for insurance. But I would rather pay for a little bit of insurance now when I, can get it, than down the pike when I can no longer get it and I likely am going to need it.
Right.
So that's why it's always better to be prepared and be adequately insured.
Right. Well, you know what? No one has ever said when they've needed the insurance, I'm overinsured. Oh shoot, I got more than I got too much from the insurance company, right?
Yeah.
So anyways, that's the insurance piece. You're going to say
The
something?
last thing I was going to say is that it's another one of those interesting things that your needs for insurance change over your lifetime.
That is also
right?
correct.
When you have children and you have jobs, you want to make sure that your kids are adequately taken care of. What happens to you, whether it's disability, premature death, and in your 70s, do you need as much life insurance as you did when you had kids early on and you had more debt?
Right, absolutely. That's well point. Well point. Absolutely. To Kyle's point is you really need to evaluate the purpose of the insurance. Do you need it, and how much do you really need? And if you look at the life insurance really is designed predominantly to pay for your loss of income, to replace it.
Yeah.
There are other.
Rich. Well, there are insurances that are meant for legacy building. But,
That's correct.
They all have their purpose.
And estate planning.
Yeah.
Insurance is used for estate planning. But again, it all comes down to, we're not insurance salesmen.
Yeah.
But insurance is an extremely important component of your overall financial plan. So now, investment planning. What's investment planning? If you think about it, it's what are your goals and objectives? Okay? And if you want a high rate of return, I'll tell you what, that's the law of compound interest. You're going to be way ahead of the curve over time. However, if you don't want to take any risk whatsoever, that's fine too. You're just not going to make very much.
Right.
Most people are somewhere in the middle. But the single largest component of risk that's applied to investment planning is what is their time horizon. And the time horizon defines how much risk they should take. So for instance, if someone needs the money in 6 months or a year, gosh darn it, they shouldn't be taking risk.
Oh, yeah.
You know, you put $10,000 into an investment that you need in 6 months or a year, and we have one of those events where the markets drop, and you only got $6,000 or $7,000 left, that's silly. Silly is a nice word I'm using, okay? So just understanding that, and then the tax component.
Right.
Yes.
Don't underestimate the tax component.
And it's remarkable how little people understand their risk tolerance, but it's pretty easy to ascertain someone's risk when it's like, well, how'd you feel in March of 2020 when the accounts went down 35%?
Right.
Or how did you feel this year?
Right.
Seeing the 60-40 have one of the worst performing years ever.
Yeah, since 1926, actually.
Yeah, so it's important to understand that, and if you're not sure exactly how you're invested, you should maybe go to a financial professional who can explain it and show you, hey, you're allocated to this target retirement 2040 fund, but in reality, this is like 80% equities and 20% bonds. You're probably more
aggressive than you think.
Yeah.
Right, or at least than you wanted to
Than
be.
you
And it's
wanted
funny.
to be, yeah.
So to your point, is it's amazing when the markets are doing well, how risky a client is. And it's amazing when the accounts are going down, like, I don't want to take this risk. So, hey, right, exactly. And that's the worst time to do it. So we didn't even make it through the first question. So we're going to have to pick this up. And it's actually really good, though. We're going to have to pick this up on our next episode of Financial Planning Explained. What we were able to do today is discuss the first 4 areas of financial planning and be able to utilize that, discuss it, some of the topics, et cetera, et cetera. So the next episode, we're going to pick up where we left off and discuss retirement planning and estate planning. So thank you for joining in. I look forward to catching up with you in the next episode. And thank you again. I'm your host, Mike Menninger, Certified Financial Planner. Thank you for tuning in. You have a wonderful day.